All right, now we're going to talk a little bit about our chart setup and research and what we need to have available to us to find the things that we're looking for. We're trading price action, so we don't need any indicators per se. But as we'll talk about later on, we do use some of them as filters. So as far as chart timeframes, now of course I've got lots of screen real estate and it's maybe a little bit overkill, though I do use it all. It's not necessary. Great thing about TradingView or something like that, TradingView is so wonderful for charting and for these research charts. The kind of top-down macro view that I'll take in the morning before I start looking for any individual trade. So what I'd like, for you to have available is daily, hourly, 15, and then a short-term, super short-term, like 5 or 2 minute chart. The basic subscription to TradingView, I don't know if it has 2 minute charts. 1 minute chart is fine. I don't even remember why I started using a 2 minute. I think I just sort of tried it one time and found that it cut just a little bit of the noise out from the 1 minute, but it was still quite short term. So that's just what I've gravitated to. But you definitely want to have a daily. And you want to have a daily chart set to day session data only. And we'll find out more later on in the course of why that is. Then you want to have an hourly chart. That gives you plenty of options. Essentially, we're looking for one macro, big chart, daily chart to kind of get the lay of the land and see where the broader market is, and also identify any gaps, which we'll get into later. An hourly chart to kind of see where the kind of range of where the market's most likely to go within the day. And then a short-term 5 or 2 minute chart or 1 minute chart to actually look at the price action up close. 15 is kind of nice because it's just sort of a step in between the two, and sometimes you don't want to see all the little sideways and up and down candles on the 2 minute chart or the 5 minute chart. It just gives you a little bit wider view of things. The 15 is something I used to trade Forex on the 15 minute chart, like day traded. So that's probably the main reason why that's there for me. But for sure, a daily chart set to day session only, an hourly, and then a short-term chart. A tick chart is ideal. If you're getting serious and you want to trade real money, I do believe a tick chart is very handy. I've always found it that way. I use one to actually execute my trades on, but it's not necessary. You can place those same trades on a 2 minute or 1 minute chart, even a 5 minute chart. I just like the feel of a tick chart. The nice thing about the tick chart is if price goes sideways and there's little volume, it doesn't print another candle every minute or 2 minutes. It compresses data quite well for the times where the market is slower. It doesn't take up so many candles. It makes your overnight chart not so long. And then whenever the market is busy, like in the New York morning, it'll print a candle every 30 seconds sometimes when the market's busy. It'll print one in 5 seconds sometimes. So it's just a more dynamic chart. You really have to try one to really see what that means and see if you like the feel of it or not. So if you're getting serious about this, it's well worth looking into, but it's certainly not necessary. If you're just trying to learn this and you want to keep your cost to an absolute minimum, you can work with time charts on a free platform. If it means paying a little bit of money to get a platform with tick charts like Sierra, I think it's well worth it. It all depends on you type of thing, but eventually I think you're going to want to have a platform that will support tick charts and various other things. As far as the indicators, Keltner channels, okay, that's what I use. People ask me quite a bit about these, and I set them to 2.5 true range, 2.5 true range. There's average true range or true range. Mine, I believe, are set to true range. It doesn't really matter, guys. It's not a big deal. I would trade them interchangeably. In fact, I remember I was checking for a friend of mine on my chart of what it was, and it was the opposite to what I thought it was. So it doesn't really matter. Very close to the same. And a 20 EMA is the other setting on the indicator. Okay, so the 20 EMA is the line in the middle that everything else is structured around. Okay, the Keltner channels are 2.5 of the average, multiple of 2.5x the true range around the 20 exponential moving average. So here they are on the chart. Okay, so there's the 20 EMA in the middle. There's the upper and lower channel. The reason I use these and lots of other traders use them. This particular inclination of it with the different, actually, yes, this one doesn't change color. This indicator that I use is the Raschke derived indicator, where it would change these candles different colors. I have that turned off, but she uses this quite famously, and she used it a lot long before I started using it, and that's where I got the idea from. So I like the look of her charts years ago, and I just kind of threw. I don't trade the same way she does by any means, really, but I just liked the look of it. I like the principle of it, and I threw it on my charts, and it's just never come off for a long time now. The thing that I like about it is because it contains most of the price action. It'll contain probably 90-95% because you're allowing it to go 2.5 times the average true range. So not like one multiple of the true range, 2.5. So that's quite a bit. It's giving price a fairly large area to ebb and flow. It inherently provides some support and resistance. Not necessarily saying that everybody's looking at this, but the fact is 90-95% of the price action is going to stay in between these lines, right? So they make a great place to put a stop loss around, and they make a reasonable place to take a trade off of. And whenever they're broken, it gives you a good clue that there's either something up or price is due for a return to the mean. And I find they give me, just at a really quick glance, a sense of where the market is right now compared to its equilibrium. You won't see me take any trade just upon this, based upon this, of it hitting the outer or the upper or coming back to the mean. But as we'll find out later, it will impact whether I take a trade or not that I find otherwise. Another thing is the reversion to the mean. Everything likes to revert to the mean. Well, you've got a mean right there on your chart to see for you, right? And you'll notice that an awful lot of the time it will come back and tag that. So that makes a really useful target if you're entering somewhere out here or out there, or just, somewhere up here when the price is coming down. You can expect you're going to get a little tag right there. See, it just does that. So it's a useful tool. Now we're also going to look at some technical indicators, okay? And there's really only 3, and they're ones that are easily available through TradingView and probably most data feeds, most paid data feeds anyway, but you can get them for free on TradingView. You do not require a paid subscription to get either of these. One is the tick. Depending on your provider, you can sometimes get a tick specifically for the Dow, the New York Stock Exchange stocks. You can get one for the NASDAQ. It all depends on what your data provider or your broker gives you. I just use the one that's on TradingView, and that's the New York Stock Exchange ticks. Now, all the stocks in the ES are not traded on the NYSE, though an awful lot of them are. So that's the one that I use. I also use TickStrike, as you may know, and they do have a specific NASDAQ tick indicator on there, which is great, but the regular tick is just fine too. It's going to serve the same kind of purpose for what we're doing with it. The advanced decline line is another thing that I will plot. And what is the tick? The tick is simply the difference between stocks, the number of stocks that last tick was an uptick, and the number of stocks that last tick was a downtick. It's the net difference between the two of them. So if it's a positive number, it means more stocks have had an uptick on their last tick than not. And if it's a negative number, more have had a downtick. Of course, it measures the difference between. So when it gets to an extreme level of, maybe plus or minus 800, 1,000, 1,200, something like that, then that indicates that, the market is getting to a bit of an extreme level of being overbought or oversold or that sort of thing. The advanced decline line, ADV, is very similar as far as how we would use it. Just measures the amount of stocks advancing versus declining. If you can't get the tick, use the advanced decline. I have them both going. For the most part, they pretty much follow each other, but sometimes there can be discrepancies. But one or the other, whatever you can get, and then the VIX, the volatility index. These are things I all have plotted on a separate chart layout, and they're things that I'd like to have you to have access to if possible, because we'll be using those later on. And the one other thing that's on here, the 310 oscillator, that's optional. or if you can't find that, but an oscillator of some kind. It doesn't necessarily have to be the 310. It can be a MACD. I mean, the 310 is a modified MACD as it is. And that looks like this. That's the thing on the bottom of my charts. I'll make it bigger here. Okay. And this is an oscillator. And essentially what it is there's a slow line and a fast line. The jagged line is the fast line. The smooth line is the slow line. And it's essentially just the difference between these two moving averages. These are moving average lines. And it just gives you kind of a sense of whether the market is overbought or oversold. Again, these are lagging indicators, right? But there's certain times, and we'll talk about it later, there's one specific situation where I do use this. I do take a look at it fairly often, but sometimes it will give me a little bump that I want to pay attention to whenever it does happen. So as you may know, you may not, that oscillators are just an indicator of a market being overbought or oversold, just kind of where it is in relationship to where it's been in the last while. And so in this case, it's the difference between a 3 and a 10 period moving average. The short line is a 3 period. The long line is a 10 period. So the short line here is taking the moving average of the last 3 candles, so it's going to be much more volatile. And then you've got the long or the smooth line that's going back 10, so it's going to be more smooth, of course. That's all this really is, and I just keep it on the bottom of my screen. And later on, of course, we'll go over what I use that for. So if you don't have this, you should just have some kind of an oscillator. So you don't need to have this on every one of your charts, but you should maybe have it on your daily and then have it on your hourly and your short-term chart. For the purposes that I use this, I'll be looking at it on the hourly and the 5-minute chart.